Welcome to Bar Chart's series of educational webinars designed to enlighten you on a variety of investment concepts, demonstrate features and tools Bar Chart provides related to these concepts, and offer some traders insight to help you make a more informed investment decision. Today's subject, value investing philosophies, Graham, Buffett, Bogle, and the efficiency market hypothesis in perspective. Now, markets are consistently evolving, but timeless investment principles continue to guide how we think about risk, return, and value. And throughout the decades, four influential ideas have shaped generations of investors, each with strengths and weaknesses and real-world implications. Starting with Benjamin Graham, the father of value investing, his approach was grounded in rigorous analysis, looking for companies trading below their intrinsic value and always demanding a margin of safety. Following Graham is Warren Buffett, who took Graham's principles and adopted them. And instead of just buying cheap stocks, Buffett emphasized buying great companies at fair prices with sustainable competitive advantages, or as he calls them, economic moats. We'll look at John Bogle, the founder of Vanguard, who believed that most investors are better off buying the whole market through low-cost index funds. Bogle's philosophy of passive investing emphasizes cost control, diversification, and discipline, which is the cornerstone to retirement funds and generational wealth. And in running in the backdrop is the efficiency market hypothesis. This is a theory that underpins much of modern finance. The EMH says that all valuable information is already priced into stocks and making it nearly impossible to consistently beat the market. Hello, everyone. My name is John Bogle, Bar Chart Senior Market Strategist, and we're going to examine these four philosophies so that we can take from them their strengths and customize them into what I would call a value investing of all. Plus, I'll show you some features of Bar Chart and share with some value metrics based on these four ideas that can help you to make a more disciplined investment decision. Now, before we get to that, please welcome our moderator and Bar Chart's project director, Jean Baker. Hello, Jean.
Happy last day of April, John.
April showers brings May flowers, right?
Yeah, I guess, yes. I usually tell you what today is, like if it's a special national day or something. It's National Bugs Bunny Day.
I love that wascally wabbit.
Yeah, me too. It's also National Denim Day. I don't know.
Denim Day.
Yeah, nothing really comes up here, so.
Forever in blue jeans, Jean.
Yes, forever in blue jeans.
All right, let's get started.
Okay.
Let's hit it. All right. Just to remind you folks today that is for educational purposes only, and decisions to buy, sell, or hold traded securities is best made the advice of a financial professional, and under no circumstances shall we be liable for any losses or damages that are incurred by any activity that you or anyone else in trading activity that you do, that anyone engages in based on the information or material that you receive through barchart.com and our services. Okay. So let's begin with, there we go. Let's begin with Benjamin Graham. So Benjamin Graham is considered the father of value investing, and he was born at the turn of the 1900s, and he lived and learned through the crash of 29, and later went on to become a professor at Columbia. Now, Graham laid the groundwork for value and influenced many modern day titans of the investment community, including Warren Buffett and Charlie Munger. Now, Graham believed that the market is an emotional, irrational partner, and that prices often swing based on the mood of the market and not based on fundamentals, something that he called Mr. Market. Now, every day, Mr. Market will give you a quotation price to be bought or sold, and you can either take advantage of it or ignore it. Now, when Mr. Market is in a good mood, and stocks with good records or good prospects will be selling at higher prices. Now, when Mr. Market is in a bad mood or in periods, as Graham called them, of unpopularity or failure to discount future cash flow or currently disappointing results, then Mr. Market's prices will be low. So price does not equal value. Graham looked at these emotional swings as opportunity, and that value is defined by things like assets, earnings, dividends, and future potential prospects. Now, Graham believed that the single most important value is future earnings power. So he believed that you could exploit the irrationality of Mr. Market to find markets that are undervalued based on something what he calls an intrinsic value. Now, his metrics for intrinsic value is current earnings times, in quotation, 8.5 plus the 2 times expected annual growth rate over the next 7 years. That would give him a price that he feels would be of fair or intrinsic value. Now, he looked at other metrics as well, things like the price of the stock not being more than 1.5 times the net average asset value, or price is 2/3 of net assets, or price is no more than 15 times the average earnings over the past 3 years. Now, these predicated with something that he called a margin of safety. And a margin of safety protects from satisfactory returns, the ability for the owner, the investor, to withstand adverse developments in their individual stocks. So another metric that he would look at would be something like he wanted to see that the company earned 5 times their fixed interest charges. In other words, their earnings are in excess of their interest payment requirements. And he looked at margin of enterprise value over debt and margin of earnings over charges. So again, when he talked about margin of safety and determining of value, another thing that he would look at in terms of price to value is he looked at low PE ratios. And he'd like to find companies that had low PE ratios where the price had fallen to half the previous market high. He also believed in fixed assets, bonds. And so he would say something like, if you are willing to buy a stock in a company, you should also be willing to buy their debt. In other words, can the company service their debt, or is the debt servicing a detriment to potential earnings? And so in that breath, he would look at something like looking at expected earnings power that's consistently above the going rate for bonds. And so this inefficiency in the market can create investment opportunities and alpha. So he would be looking for corrective forces in these inefficiency markets, are Mr. Market. So Graham would be saying he would like to look for candidates in bear market corrections, and again, when they are below their intrinsic value. So Graham was the one who really coined the phrase fear and greed. In other words, he wants to buy from Mr. Market when he's fearful and sell to him when he's greedy. All right, so that brings us to Warren Buffett. Now, Buffett learned from Graham. He actually worked for Graham for a while, and he took Graham's strict quantitative guidelines. But Buffett realized that many stocks that were cheap was because their underlying businesses were suffering from an end of a business cycle. In other words, declining revenues or declining earnings. So Buffett turned the idea of margin of safety into a qualitative approach called durable moats. Now, a durable moat is something that would be a sustainable competitive advantage for a company that would protect it from competition over a long period of time. Help it to maintain pricing or strong market share, and again, maybe above average profits. So Buffett defined many moats, and some of them would be brand loyalty, cost advantages, uh, network effects, switching costs, and efficiencies to scale. So when we think about these moats, there is some kind of value or metrics that could be defined based on the different categories or performance measurements. For instance, under brand loyalty, we could talk about high gross margins or consistent return on equity and strong free cash flows. These would be companies that have strong brand loyalties would be able to achieve. Cost advantages. Do they have low operating costs relative to their competitors? Or is their free cash flow divided by their sales greater than 10%? Buffett also talked about network effects. In other words, number of users or more users than competitors, or subscription growth. Think of companies like Netflix and Apple. Apple at one time was a value company. And then efficiencies of scale, right? Stable market share, CapEx expenditures divided by sales of less than 10%, stable EBITDAs across market cycles. So these valuations are what we would call business qualities. Now, Buffett also believed that the market was generally efficient, and there are moments in time when opportunities become available based on mispricing. And I'm sure you probably heard the quote, be fearful when everyone is greedy and greedy when everyone is fearful, something that Buffett learned from Graham. These are the times of mispricing. And again, under business quality, Buffett would look at metrics, for instance, or what he would call tenets. And some of those things that he would think about would be this, time is your friend for wonderful businesses. And he was quoted as saying that time in wonderful businesses is profitable, but an enemy of mediocrity. And another piece of his qualitative approach is business matters, and management can also affect the value of the underlying. So under business qualities, he has these tenets. So let's think about things like business. So you hear Buffett say something like, is the business simple and understandable? Can it be explained in 30 seconds or in 2 sentences? Is there a consistent operating history, something that Graham taught him, and favorable long-term prospects? Under management, is the management rational and candid with shareholders? And does it resist institutional imperatives, set of pressures or habits that lead to poor decision makings? For instance, herd mentality or resistance to change or spending just to chase returns. Financials as well. Buffett would like to focus on return on equity and not so much on earnings per share. Again, something he learned from Graham. High profit margins. And one of Buffett's favorite metrics is every dollar retained creates at least $1 of market value. That would be a financial efficiency. And then markets itself. Can the business be purchased at a significant discount or to its current value? Now, Buffett would say that he would more likely buy a company at fair value than trying to find those that are at deep discounts like Graham. But one of his margin of safety rules would be discounting, looking forward at free cash flow or future cash flow. And this would be one of his metrics of margins of safety. So Buffett does acknowledge that people, general retail traders, might not be able to beat the market. And he does endorse index funds for the average investor. In other words, what he's saying is if you don't have the time to do your homework, then this is probably where you should be falling into. Now let's talk about John Bogle, who is the founder and developer of what we would consider is modern passive investing. Now, it makes sense that the CEO of a fund company would endorse passive investing, but his philosophies have a lot of merit. And one of them is costs, especially fees that they eat into returns over time. And so minimizing expense ratios or trading fees or turnover, churn, and taxes, paying taxes for every time you take profits, focus on your return on after-tax returns. These all put active investors at a disadvantage. And so he would endorse low-cost mutual funds and ETFs. Now, if you think about management fees or fees in general, a 1% fee can consume 20% of your gains over 30 years of investing. So that's pretty significant, and I think is something that we need to take into consideration. But Bogle also believes a little bit in the efficiency market hypothesis, where he says that public information is already priced in. So rather than trying to beat the street by picking individual stocks, why don't you just own the entire market? And Bogle would say, don't look for a needle in the haystack, just buy the haystack. Now, he also advocates, staying the course, long-term passive investing. One of his famous quotes is, the stock market is a giant distraction to the business of investing. And he's also been noted as saying that time in the market beats timing the market. In other words, buy and hold. But other things that Bogle would advocate is ignoring market noise and resisting emotional decisions and sticking to your plan. Something that I always say in our webinars, plan a trade, trade a plan. Now, sticking to your plan regardless of short-term volatility. So things like avoid selling in downturns, modest rebalancing, and let compound interest do its work. He was also advocating a dividend reinvestment and dollar cost averaging. So if you think about the EMH and Bogle and together, Bogle would encourage investors to embrace humility and focus on what they can control, allocations, costs, and behavior. So running the backdrop of all three of these philosophies is the EMH, which is this idea that market is rationally priced mechanism that incorporates information efficiently. In other words, the market discounts all information. Our price discounts all information. And that price, current price, is of fair value, especially when we think about any mispricing is quickly arbitraged away. So we have to accept that prices are fair and that consistent alpha does not possible due to rapid information diffusion. Think about how quickly information is dispersed in today's modern world compared to these theories that were developed many years before the internet. So I would say it's probably even quicker and more rapid. And so passive investing or index funds is the optimal, since outperforming is statistically unlikely. Most fund managers underperform the indexes, something that is a statistical truth. But the EMH offers some important insights. You know, Buffett would say the market is efficient most of the time. It's only a very small portion of the time where it is inefficient, and that the EMH does not explain things like bubbles and crashes and other investor overreactions. And again, in reality, markets are made up of people, and people don't always behave rationally. So let's do a comparison and analysis quickly of these three different styles. So Benjamin Graham is about deep value investing, right? Based on balance sheet strength and margin of safeties. Remember, think about things like assets, dividends, and earnings. Where Buffett was more about value investing by buying great businesses at fair value. And Bogle and EMH tells us that the markets are efficient and just buy the market at whole. Don't spend time looking for that needle in the haystack. In terms of market efficiency, again, Graham said that Mr. Market is irrational or emotional, and so price does not equal value. Value is determined by those assets, dividends, and earnings. Buffett believed that looking for opportunities in markets, it comes only occasionally, right? One of the quotes I found fascinating about Warren Buffett is said that, you know, he limits the amount of trades that he does in a year, something like somewhere between 3 to 5. Think about that. Here's Buffett is telling us that he knows the market is efficient most of the time and that mispricing opportunities are rare. And so that why he limits the number of trades that he does in a year. Now, the efficiency market hypothesis in John Bogle will tell you, hey, the market is efficient at all times and that there's no advantage to waiting for lower prices. In other words, if you buy today, you're buying a fair price. If you buy 6 weeks from now, you're buying a fair price. If you buy 6 months from now, you're buying a fair price. If you buy 6 years from now, you're buying a fair price. And in the long run, prices will go up. Well, what's the edge of each one of these philosophies? So there is a discipline, patience, and that analysis of undervalued stocks that Graham presents. Buffett looks at long-term focus, right? Staying in it for the long term and understanding these durable moats, these competitive advantages, looking for good companies in good businesses. And Bogle will tell us that there's really no advantage to the trader, and that the only advantage is to minimize their costs. What stocks should we look for? Well, under Graham, he looks for something that's called cigar bucks. Actually, it's a term that Buffett called Graham stocks. You think about a cigar butt that is on the ground that has one or two more puffs in it. I know that's kind of a gross idea, but that's what he's talking about. Cheap companies that have a lot of assets that are often in mediocre businesses. Where Buffett says, hey, I don't want to buy these ultra cheap stocks. There's a reason why they're cheap. I'd rather buy a good company at a fair price with long-term prospects. And Bogle will tell you, well, there's no advantage to picking a particular stock, that you just should buy the broader indexes or the total market index. And in terms of risk, Benjamin Graham will say volatility is not risk. Volatility is actually an opportunity, that irrationality of Mr. Market. The risk is overpaying. Remember, he's looking at cheap stocks. If you overpay for a cheap stock, you might not ever get that return. Where Buffett says risk is not knowing what you're doing, and emphasizes that business fundamentals, those business qualities. One of our Warren Buffett's quotes is, you don't buy a stock, you buy a business. And Bogle and EMH tells us that risk is really just a standard deviation or volatility, something like VAR, value at risk, or expected risk over expected gains. These are all modern techniques of portfolio management. And investment styles, right? Graham is more defensive, qualitative, and bargain hunting. Buffett is concentrating on only a few qualitative aspects, long-term ownerships of high-quality companies. I kind of call this that best of breed, right? Who stands out in an asset class? Who stands out in a sector? Who stands out in an industry among their competitors? And Bogle will say, hey, again, let's just diversify, right? Let's try to get everybody in our basket and be very rule-based and buy and hold. There's no reason why we should even worry about price fluctuations, right? We know that in the long run, as long as the market goes up, we are going to do well. Okay, so there are many key metrics we can look at to assess value, and I'm going to share some with you. And I'm not saying all of these are the wherewithal or set in stone, but some of these are based on the collective values that were presented in the dialogues or the philosophies of the principles of these three different individuals. But something like a PE ratio, price to earnings ratio, that helps us to assess whether a stock is expensive or cheap relative to its earnings. Debt to equity ratio, again, something that tells us, is the company financially healthy, or are they using raise capital in an effective way? Return on equity, right? Something both Graham and Buffett focus on, right? How efficient is a company generating profits from their shareholder capital? Price to sales, right? Is the market, Mr. Market, telling you, hey, things are great and the price is inflated based on their sales, or is the market discounting, Mr. Market discounting the price versus their sales? So these are kind of just simple metrics I think you can talk about, but I think these are a great starting point for helping us to define the value and the quality of individual companies. And so what I did was I created a screener. Now we're going to go look at this screener live. I just want to show you it's in the slides so that when you go to download the slides, you can recreate what I'm doing with some different matrices. And then we're going to look at that passive investing aspect as well. And so we'll look at some ETFs that are value ETFs and are what we would call Buffett ETFs. Okay. So I just wanted to show you that they are in our slides. Okay, come on. There we go. All right. So one of the benefits of being a bar chart member or being access to bar chart is, excuse me, under stocks here, we can go to stock screeners. And in stock screeners, there's a way that we can screen over multiple stocks, a large pool over multiple of different types of filters, be it technical analysis or in case you're interested in fundamental analysis. For instance, income statement, balance sheet, cash flows, right? So if you know what you want, you could type in something like earnings, and there's a lot of different metrics that revolve around earnings. Or you could go to, let's say, something like financial ratios, and there's a lot of those different financial ratios, a couple of the ones that we just mentioned. So what I did was I took a lot of the philosophies of all these different individuals and listened to what they were saying, and I was like, okay, let's see if we can find some of those matrices that bar chart can screen on and see if we can find some rules or tools and to help us with these looking for value investing. So this is what I came up with. Let me kind of do this so we get a nice big screen here. So the first filter that I put in is market sectors. Now I'm going to show you the reason why I did this, but it's really I just want to know what sector that market is, and that's part of my top-down process, and I'll explain to that in a moment. But I just want to know what sector that stock is. It's not really important in terms of value, but it might help us define business qualities that we want to invest in. So we can talk about dividends, right? Again, these are all just collective values that, again, this dialogue of our philosophy. So dividend yield. So again, notice I don't put a value here. I'm just going to use this as a comparative. But Graham points out that this is added to our satisfactory return, part of that margin of safety. But Bogle also talks about that compounding aspect, right? That compounding element. Now, did you know that if you take a percentage yield and divide it into the number 72, it tells you how many years, all things being equal, of course, how long it would take to double your investment. In other words, if you're, getting, say, a 5% return, 5 goes into 72 about a little bit less than 15 times. In other words, the dividends alone on a 5% yield would tell you that within a 15-year period, your stock price based on dividends would double, or your return would double. So then, again, dividend growth. Again, something that both Graham and Buffett like to look at. Again, I use a very low threshold here. Obviously, we want to look for companies that are not only have a higher percentage, but are consistent. So I use 5 years, but Graham said that he would like to see 20 years of dividend growth. Again, think about the companies that he might be looking at. But think about growth as a principle of our fundamentals. In other words, growing dividends is a sign of a healthy company, right? But also growth in other things. For instance, growth in our return on equity or growth in our cash flow, right? These are signs of a growing market or a healthy stock. Again, remember Graham said he wants to see an expected return that's greater than the bonds. And so if you look at today's bond market, somewhere in the mid to low 4%. So that's why I use this value of 5%. But I think ultimately, when we're looking for value and we're looking at that growth equation, I think we want to look for probably something that is more like 1.5 times or 2 times the bond rate. So again, net cash flows is a sign of earning strength and operation margins, and also again, pricing power. So the more cash that they generate, it's probably because they're selling their products for a lot more money. And that again, that would be in line with our price to sales. Is the market discounting our price versus our sales? Now, Graham would tell us that he would like to find those that are below 1. Buffett tells us somewhere is below a 2 valuation, because those would be more fairly priced. Debt to equity. Well, this one is obvious, right? We want to make sure we have more equity than debt. But again, there is that management style, right? Buffett says business quality, that rational management, right? Are they fiscally responsible, right? Is the debt that they're taking on being put to good use? So all of these gentlemen would probably say that they would want to find a debt to equity ratio was probably below 0.5. But in this case, I'm just using that they make sure that our debt is not above our equity. And then price earnings growth. Again, that growth equation, again, divided by our price earnings. Again, a very simple metrics would be here. We want to find that ratio that is 2 or below. And then ending with price earnings forward. So Graham, again, acknowledges that growth stocks are probably going to have a higher price earnings forward, something like 25. And I think in the modern world of investing, I think we can say that asset prices have been inflated for a long period of time because of liquidity. So that might be the higher end of the standard. But again, what was the risk that Graham said? Well, the risk was overpaying, and a higher price earnings forward would mean that you're overpaying. So he kind of wanted you to be at 15 times or below. So I split the difference. So somewhere around 20. And I think that's a nice historical number as well when you look at the S&P. So let's look at the results here. Okay. Now, let me just go back here for a second. Notice the pool that we're pulling from. We're looking at all New York Stock Exchange, NASDAQ, over-the-counter, even some non-common stocks, right? So these are that demanding financial filters, but notice what our result here. We only get 66 companies. I think this is a reflection of the signs of the times that we're in, that of the thousands of stocks that we can pull from, we only get 66 that meet all of these qualities. Now I'm going to do something in a little bit with Warren Buffett and Warren Buffett style, which would be even more amazing. I think it also answers a lot of questions about what's going on with Mr. Buffett. But again, let's look at these stocks, these 66 stocks. Again, what I do is, you can sort any of one of these filters that we picked. So I'm just going to sort by sector. Again, the reason why I do this is part of my top-down approach or sector performance approach. I want to see which stocks are falling into which different categories. Maybe those categories are the beaten down or at the bottom of performance, downtrodden. But again, also I might be curious about seeing, a sector rotation that's on an upswing. Maybe, finding, some of those stocks that have value in a sector that seems that is attracting capital. So that's kind of why I want to do that. So let's do this now. Let's look at these stocks and with the lens of Warren Buffett, or what Warren Buffett is teaching us. So the first, again, business qualities and those moats. So, let's look at like Ashland, right? What Ashland is? Well, it's a chemical company, specialty, right? A barrier of entry. Does it have good pricing power? Well, let's look at its return on equity. Let's look at its net cash flow. And it has a low PE, right? So that's, and also dividend growth, right? What is the dividend growth over the last 5 years, right? A sign of a healthy company. Let's go down a little bit farther in our list. Louisiana Pacific. Again, let's think about this in terms of moats, right? This is a wood, building products wood. Yeah, could the market be depressed right now because of thoughts about recession and everything? Again, we're not concerned about what the market is doing, right? That Mr. Market, and this might be actually a potential buying opportunity. Again, I'm just going through this. These aren't recommendations, but does Louisiana Pacific have a competitive advantage? They're one of only, I think, a handful of wood producers in the U.S., exclusively in the U.S. Look at their positive cash flow and their strong return on equity. So again, we're looking at the stocks from those perspective. And then finally, which is kind of interesting, that Gene told us today is National Denim Day. And Gene, check out this down at the bottom of our list here. Not saying that it's the bottom because it's not a good one, but at the lower end here under retail is Levi Strauss, right? Talk about your brand recognition, right? Everybody knows about Levi's jeans, right? Everybody has jeans. And again, let's look at some of these metrics. Low debt, greater growth, return on equity, all things that we've just learned are what we want to look for in value opportunities. Now, and again, one of the other things that you can do with bar chart is you can go to our flip charts, and again, these are all the stocks here. And so let's look at those stocks in terms of their charts. So the first one is Ashland that I just brought up. And one of the things we learned from Graham is he likes to find low PE values where the market is discounting, right? And that the price has fallen 50% from its all-time high. So here you can see our all-time high was around 114, and now we're well below 50%. The next one was LPX. Where are you? There we are. Okay. Again, probably not a 50% story, but what was Buffett's idea? What was Graham's idea, right? Companies that have done well historically over longer period of time. So let's change our time frame from daily to weekly, and let's condense our time frame. And would you say, since the great financial crisis, this is a stock that has done extremely well or has continuous performance? And I think we could say, yes, it does. And then where is Levi's? There it is, Levi's. And relatively new stock in terms of history, but again, another stock that has fallen over 50% from its all-time high. Okay, so that's the individual or active investor. Let's now look at the market from the Bogle EMH aspect of, hey, let's just buy the broader indexes. or maybe we can incorporate the idea of let's look to diversify and maybe look for value in some value type ETFs. In other words, I'm not smart enough, or I don't have all the information, or I just don't have the time to do this analysis. So what I did was I created a watch list here. Actually, you know what I'm going to do before I do that? Let's go back to our screener. And I promise you to show you something kind of cool. So under investing, under the investing section, we have some theme lists. And one of them is Warren Buffett's stocks. These are all the stocks that are in Warren Buffett's portfolio, okay? And you can look at them, right? There they are. So one of the things we can do on screening is not only can we screen on basic fundamental metrics or technical analysis, but we can also screen on other lists. So here is bar chart pages. And I'm going to go to investment ideas. And I'm going to add Warren Buffett. So what we're now doing is we're looking at Warren Buffett stocks from that lens of Warren Buffett's value investing. And watch what happens. This is very fascinating. Only one company in Buffett's portfolio today would be considered a value company. And there it is, LPX, Louisiana Pacific. Now, up until a couple of days ago when I was doing this performance or doing this analysis, Chevron was in there as well. I don't know why Chevron dropped out today, but maybe it's up in price. I don't know. But those were the only two that were in it. So this is a really interesting dynamic if you think about it, because what has Buffett been doing? Why has Buffett been one of the best traders, let's say, in the last 20, 25 years? He knows value. And why has Buffett been accumulating cash? Well, right, he has $300 billion in T-bills. Well, because he just can't find any value right now. And matter of fact, the only value in his portfolio would be this one stock. So I thought that was kind of fascinating. So I hope you guys like that. All right. So let's take the aspect of looking at ETFs or funds, right? Now, again, if you aren't familiar with bar chart site, you can go into ETFs here, and there's an ETF screener finder, and you can screen by equities, you can screen by sector indexes, right? Strategies, right? Wide modes. We could go by, specializing growth and value, right? Small growth, mid growth, right? So that's kind of what I did was I went and looked at. Now these are not all of them, just a few of them. But again, some of these are value index funds, and the other ones are investing based on the principles and philosophies of Warren Buffett. Now, which is kind of interesting, again, in terms of doing a little market analysis here. I'm going to sort these by performance here, and I'm going to look at 3-month performance. Now, I threw in Berkshire Hathaway. Now, Berkshire Hathaway is not a ETF, right? But if you think about it, when you buy your Berkshire Hathaway, you are getting all these stocks, which in essence is a diversification, right? And it is what I would consider a kind of a quasi ETF. So again, let's look at performance, and we do this by 3 months, and which is really fascinating. Again, notice out of all of the indexes here, or ETFs, the only one that has actually performed over the last month and over the last 3 months is Berkshire Hathaway. So again, this kind of is our point that maybe the EMH is not, or this, is not a true, or that this is kind of breaks that, right? So how can an individual or an ETF in this case outperform the greater market? Because if you look at everybody else, they're all kind of doing the same thing. Okay. So let's see. I see a couple questions, Gene. Let me see if I can answer a couple of them while we take a second here and before we finish. Craig asks, what is Graham's metric formula? Again, let me look that up for you. I think it is current earnings times, in quotation, 8.5 plus 2 times the expected earnings growth over the next 7 to 10 years. So in other words, if your expected earning growth is 5%, so it'd be 8.5 plus 5%, which is 13.5 times 8.5. Okay, so that would give you the price value. All right. So a question about dollar average cost. How do you get out of position? For example, when you retire? Well, again, I think that's the same. You're going to sell you're going to have a plan. You're going to sell a certain amount of your portfolio over a certain amount of time. Now, when you're going in retirement, it's probably that is going to be defined by the individual and how much they're going to need, right, from their retirement company. If you need X amount of dollars, then you're going to sell X amount of shares to cover those X amount of dollars. So that's kind of the inverse of dollar average cost. Fernando asks, best books written about each one of these methodologies, Graham's, Buffett, and Bogle. Okay, so that's a great question. So Graham has 2 books. One is The Intelligent Investor, which was written, I think, in the late 30s. I would recommend that you get the 5th edition. This is just before he died, and it has a little bit more modern take to it. Buffett, there's a lot of books out there about Buffett style. I don't have a particular favorite one. And then Bogle, yeah, there's a book. Let me think of the title here for a second. I got it over here. It's by McGraw-Hill. It's called Bogle on Investing. I think there's a ghostwriter, but it is John Bogle's book. So those ones you can look at. All right, let's see. I think Gene's done a good job answering a lot of these questions. Thanks, Gene. Okay, I think we got most of those some good questions. If I didn't answer all of your questions, send them to support@barchart.com. Okay, let's do this before we end today's session. All right, so in summary here, so which philosophy is right? I don't think there is a right or wrong philosophy. I think it's more it fits which one fits your style, your discipline, how much time you have, time to look at them, or what is your time horizon as a trader as well or investor. I think Graham's strength is he offers these timeless lessons in discipline. In other words, patience. Don't be swayed by emotions, right? Look at the market from some very hard numbers, assets, dividends, and earnings. Buffett, I think what Buffett's strength is, this quality of business, right? Those tenets of business. And then again, right, we're in this for the long term. I think Bogle tells us that, keep it simple, right? Keep it simple, stupid, right? And that be aware that if you're an active investor, every time you buy and sell, commissions, taxes, right? Churn, right? Or if you're buying and selling different ETFs, look at the management fees, which is kind of interesting. Let's look at, let's say, I'm not picking on one or another, but let's look at, for instance, this economic MOAT ETF. Now I have to go to their business page, right? Their management fee is 0.60. Well, if we go to Vanguard, right? But what Bogle says, hey, let's just buy the whole market, right? You know, here's the Vanguard S&P, right? Look at their management is 0.03%. So again, managing fees, right? Managing, and then again, those allocations, right? Consistently investing in the market over a period of time. That's kind of whatever our, right? That's what your 401k is, right? That's exactly what it is. All right. You know, in EMH, right? That challenges us to be humble that, you know, we don't know all the, you and I don't know all the information, and that the market is constantly reacting to all that information. But we also prove or disputed that, you know, there could be moments in time where there's exuberance or depression, so to speak, where the market could be out of balance, or that there could be potential opportunities for us. And certainly Buffett as results is telling us that. And that in the end, really, I think is the best that we take from all of these individuals and combine them together in a very rational analysis that is non-emotional and disciplined, right? I think that makes a lot of sense to us once we think about this in terms of the big picture. Okay. I hope you guys enjoyed that. It was a little bit different from what we normally do on our Wednesday webinars, but I think there's a lot of value and learning aspects to it. All right, next week's webinar is not up yet, but I will tease that one for you. We're going to look, there's been a lot of stocks have been doing the death cross. So just make sure that you sign up, give us your email, and we'll send you that notification when it comes. We're going to look at the death cross as a trading tool. And again, I'll remind you that all of our webinars can be found in our archive. And again, you can search by subject matter. And if you go to under value investing philosophies, here's where you can download those slides. All right, Gene, did I forget anything?
Nope, I don't think so, John. We're all good.
All right, Gene. Thanks so much. Happy Denim Day, Gene.
Yeah.
All right, folks.
Yeah,
Until
happy,
next time.
happy denim.
What's that?
Happy denim.
Until next time, folks out there. Best of health. Manage your risk, and the good of all trading.